As of the market close on Friday, July 24, 2026, KEEL Infrastructure Corp., trading under ticker symbol KEEL on the NASDAQ, settled at $4.40 USD, marking a sharp single-session drop of 8.52%. Trading volume surged past average daily levels as institutional hands shuffled massive blocks of shares, reflecting intense volatility across the broader small-cap technology and digital asset infrastructure ecosystem. Most retail traders looking at their screens on retail platforms like the Robinhood app or browsing equity feeds on SoFi Invest see this drop and immediately assume that KEEL Infrastructure Corp. Is just another struggling crypto host getting battered by shifting digital asset values. The prevailing narrative across popular investing sites suggests that when mining economics compress, companies built around server farms are destined for margin collapse. But if you look beneath the headline price movement, the reality tells a completely different story. What the market is actually pricing in right now is not the failure of an old business model, but the massive, messy capital drag of a structural pivot toward high-performance computing and artificial intelligence data infrastructure. Investors using an individual brokerage or executing orders through the Interactive Brokers platform often expect immediate margin expansion when a company pivots toward AI infrastructure, assuming that mentioning high-performance computing will instantly boost the stock price like it did for NVIDIA stock or Apple stock during their big rally phases. The reality on Wall Street is far more demanding. Power infrastructure requires upfront cash, massive debt issuance, and heavy dilution before a single megawatt generates steady long-term lease revenue. Over the past month alone, KEEL shares have tumbled roughly 35%, even as short-term weekly bounces gave active traders brief opportunities for relief rallies. This severe downward drift reflects a tug-of-war between short-term sellers reacting to debt offerings and institutional buyers quietly building positions for a multi-year grid power play. Looking closely at recent trading activity, the selling pressure accelerated following the company's upsized $400 million convertible senior notes transaction. In the short term, market participants on the Robinhood stock trading app and retail forums viewed debt raises as direct threats of shareholder dilution. When a company issues debt that can convert into equity, arbitrage hedge funds often sell the underlying stock short while purchasing the notes to hedge their positions. This structural dynamic created heavy overhead pressure, capping every attempt at a sustained breakout. Yet institutional tracking data shows firms like Susquehanna International Group and Jane Street Group maintaining sizable stakes, while exchange-traded funds including the iShares Russell 2000 Index Fund and Vanguard Extended Market ETF hold millions of dollars in underlying shares. If you track portfolio allocations in Schwab Intelligent Portfolios or hold funds via Fidelity brokerage accounts, you know that small-cap infrastructure plays carry a high beta coefficient, sitting above 4.25 for KEEL. That means whenever broader tech indexes flex, KEEL moves with 4 times the intensity. While retail investors panic over day-to-day candles, institutional wealth management desks look at the core bottleneck facing global technology giants: raw power access. While hyperscalers are desperate for gigawatts of grid interconnected capacity, securing new utility interconnections in North America can take anywhere from 4 to 7 years. KEEL Infrastructure Corp. Already holds an established pipeline of over 2 gigawatts with existing grid interconnections in high-demand power markets like Pennsylvania. That structural advantage is what transforms this stock from a simple crypto play into a prized power landlord. To evaluate whether this current valuation represents a buying opportunity or a value trap, we need to examine how the underlying business operates. Originally founded in 2017 as Bitfarms Ltd., the organization built its footprint by building and operating large-scale data facilities designed for Bitcoin blockchain validation. In that legacy setup, revenues swung wildly based on network hash rates and power costs. Realizing that relying strictly on volatile digital token prices created an unsustainable cost structure, management executed a corporate rebrand and strategy shift to KEEL Infrastructure Corp in early 2026. The objective was simple: convert raw power capacity into multi-year fixed-fee lease agreements supporting high-performance computing and AI workloads. Today, the business operates on a dual-track model. On one side, it maintains legacy operational sites that generate immediate cash flow through computational processing and third-party hosting. On the other, it is retrofitting and building out data centers fitted with advanced liquid cooling and high-density power delivery designed specifically for enterprise AI clusters. The financial transition, however, is far from smooth. Recent quarterly earnings reports show negative net income alongside substantial capital expenditure outlays required to upgrade substation hardware and build out fiber connections. For self-investing enthusiasts managing their own accounts on SoFi Active Investing or using a Fidelity mobile app, these reported losses can look alarming at first glance. But in capital-intensive asset builds, initial loss periods are standard while physical sites are constructed prior to tenant lease activation. Comment below how many shares of KEEL Infrastructure Corp you currently hold in your portfolio, or tell me if you prefer investing directly in big tech names like Tesla stock over small-cap data infrastructure builds. Understanding where KEEL goes next requires looking at upcoming catalysts and risks through the expectation versus reality lens. The market expects KEEL to face ongoing revenue pressure as crypto block rewards compress, assuming the company will struggle to fund its data center conversions without continuously issuing new equity. If that pessimistic scenario plays out, high debt servicing costs could weigh on equity value for extended quarters, keeping the price anchored near multi-month lows. Furthermore, if power utility regulators delay grid connection approvals, or if commercial hosting contracts take longer to close than anticipated, the stock could retest lower technical support zones around the $3 mark. The counter-narrative, the reality that institutional buyers are positioning for, is that high-density power contracts are currently one of the rarest assets in technology infrastructure. As hyperscale cloud providers run out of ready power in traditional hubs, they're forced to lease capacity from independent infrastructure operators who already control energized sites. If KEEL Infrastructure Corp successfully secures long-term enterprise tenant agreements for its Pennsylvania pipeline, it converts speculative computational capacity into predictable, high-margin recurring cash flows. Analysts covering NASDAQ KEEL maintain target estimates ranging up to $10 per share, reflecting the massive valuation gap between legacy crypto hosts and enterprise data center real estate investment trusts. When evaluating online investing opportunities across self-directed platforms, whether you execute through interactive brokers platform tools, manage Fidelity mutual funds, hold Fidelity ETFs, or explore options on Robinhood investments, managing risk in high-volatility infrastructure plays requires looking beyond surface headlines. KEEL Infrastructure Corp sits directly at the intersection of energy availability and artificial intelligence demand. The market's current expectation focuses on short-term dilution, recent price drops, and historical losses. The underlying reality, however, centers on who owns the physical grid power rights in an energy-starved technological economy. As the company approaches its upcoming August 2026 earnings release, traders using SoFi stock screening tools and interactive brokers trading accounts will be focused on two key operational metrics: capital expenditure conversion efficiency and tenant lease announcements. Should management show tangible progress in securing multi-year AI hosting commitments while keeping debt costs contained, the market will be forced to re-rate KEEL from a distressed digital asset processor into a valuable infrastructure provider. On the other hand, if execution stumbles or tenant conversion lags, the stock will remain bound to high volatility and retail market sentiment. Navigating this ticker requires recognizing that short-term price swings often hide long-term asset value, and in today's tech environment, secured power capacity remains one of the ultimate strategic assets on the board.